Well, welcome to Coffee with Ardill. It's Ian Ardill here. I'm joined together with Kyle. Kyle is the national business development guy. Kyle, I'm butchering your job title. I apologize. Kyle, thanks so much for being on the Coffee with Ardill today.
Yeah, appreciate you having me in.
Before we dive into our conversation, I'm just going to give everyone who's listening in just an ever so brief intro to our team. I can't believe it, there's 7 of us on our team here at Ardill Group. But really, there's 4 people that somebody's going to interact with on a regular basis. And I'm going to let those individuals just give a ever so brief introduction to them because, again, they're amazing. And it's always helpful to recognize that you're interacting with real team members who care about you and your money. So I'll let you introduce yourselves.
Hi, I'm Alejandra Dos Ramos. I'm an advisor at the Ardill Group. I've been here for shy of 4 years now in different roles. And I'm glad we have this opportunity to come together and learn more about Newlook. And please enjoy today's webinar.
Hello, I'm Darlene Abali, VP of Operations here at the Ardill Group. I've been with the team for over 17 years, and I'm really proud to support our clients and team, making sure everything runs smoothly and most importantly, stays compliant. I want to thank everyone for joining us today.
Hi, everyone. My name is Ana Fasolino, and I'm the Client Support Manager here at Ardill Group. I'm your first point of contact for any question or support you might need. I am always here to help. I'm so happy to be joining you today for our last webinar of the season. What a wonderful way to wrap things up with Kyle and Newlook. So thank you all for being here and enjoy this webinar.
Thanks so much, Anna and Ali and Darlene. It's great to have you a part of it. Kyle, it's so good to be with you. Kyle, I think you and I met at least 2 or 3 years ago, and I remember hanging out with you on the beach in Mexico at a conference. It's it's great to get to know you more. And we had a joke amongst the advisors that we joked around calling you Mr. Esquire. I don't know if you know that.
I did not know that. This is the first time I'm hearing this, but I'll take it as a compliment.
Absolutely. You're always very well dressed, very well put together, and extremely well spoken and knowledgeable. But tell me, just give us a snapshot and give us your, a snapshot of who you are as a person, and then tell us a little bit about your role at Newlook.
For sure. So I'm just shy of 30 years old, so 29, turning 30 obviously next year. And I graduated the University of Guelph, so I did finance and economics as my undergraduate degree. Entered the industry back in, I think, 2020, so great timing on coming into the work field. I started kind of as like transition advisor associate at a different firm, learned about private equity while I was there, and really thought it was a very unique, very specialized, interesting field to get into. Ultimately ended up at Newlook. I've been here now for well over 3 years. It's been a phenomenal 3 years with Newlook. I live over in Oakville, so just outside of Toronto, Ontario, for those of you who are not actually in the province. For me, I've got a great partner that I currently live with. And just learning every single day more about the finance industry and really getting excited. So at Guelph, I was a dual sport athlete. I did track and field and I did football. So I think a lot of my extroversion kind of came from the sports side of things, doing leadership type roles there. And actually currently after university, I pursued world long drive competitions. So currently that is my endeavor outside of work. So I try and hit the golf ball as far as I possibly can.
Cool.
Yeah.
Amazing. Well, thanks, Kyle, for sharing and just kind of ratify for us exactly your role at Newlook.
Yeah, so my role here at Newlook is on the capital raising side. I'm kind of first point of contact for our advisors of all channels, whether that's EMD, CRO, family office, institutional, all across Canada, as well as the United States as well, and actually Europe. So kind of all across the board there, interacting with investors and advisors on a regular basis.
Thanks, Kyle. Oh, well, I know you've got an amazing slide deck ready to rock for us. So why don't you pull it up and we'll dive right in.
Absolutely. Perfect. All righty, can you see that, Ian?
Absolutely.
Awesome. Yeah, so I mean, just kind of going into a bit of a background on Newlook to start things off. Again, as I said, started here 3 years ago, but Newlook really was founded back well over 10 years ago. So Elroy Gust is our founding partner and CEO, and he's really a serial entrepreneur. So he comes from a background of buying these types of businesses that we currently invest in. That's really how it started. He was looking at businesses, whether it was real estate, whether it was retirement homes, whether it was logistics, trucking, anything along those lines, car wash. So again, he is one of those serial entrepreneur guys that is exactly who you want at the helm. And then in 2013, him, Abbas, Tony, and Gavin kind of got together and they bought this company out in Alberta. And it was a gas detection company. They didn't really realize, they knew it was a great company, but they didn't really understand until they ran it for about a year what the utility of it was. And they realized that what the underlying utility of this company was is the fact that it's code mandated and heavily regulated. So they kind of got together and said, look, I think there's something here. I think we can kind of create a fund, make a mandate, a thesis out of all of this. So it really started when these four got together and they found a great company and they eventually built what we now know as the Industrial and Infrastructure Services Fund here at Newlook. So that's really how Newlook was founded. Again, just taking a look at the inception again. So it was 2013, well over 10 years. So again, from a track record perspective, these guys have been together forever. And just taking a look at the team. So I think what's really important, Ian, and for investors to know is the original six partners are still the six partners here today. So we've had no turnover at the partner level and minimal to no turnover at the management level as well. So Sean Fontaine heads up our dental fund. He's been here for 9-10 years since the inception of Newlook. Mike Harrison runs our industrial fund, and he's been here effectively since the inception of Newlook. He actually graduated a U of T and had an internship here, and that's how it started. So we see a lot of new grads come out. We have them as interns, and then eventually they end up actually staying on full time. So I think it's really important just to note that it really is minimal turnover here at Newlook, and it's the same people making the decisions day in and day out. So I think it's that consistency that can really give advisors and investors comfort. As I kind of noted, so Newlook is our overarching umbrella, started effectively as Elroy's kind of quasi-family office. And then obviously they went into that multi-gas deal and built out the industrial fund. So that's really how we started. That's our bread and butter on the industrial side. And then after a few years, we built out and moved into the healthcare sector as well and had these two very specialized funds. That's really what we want to do here at Newlook. We want to be specialized, and we have dedicated teams for industrial, dedicated teams for the dental. And I think that really sets us apart. We don't want to be generalists. We want to be experts in what we're doing. And again, taking a look at the track record we've developed over the last 10 years, I think it really does speak for itself in these two sectors.
Awesome. Thanks, Kyle.
Yeah, absolutely.
So, I think it's healthy to recognize how much assets under management today would you have between the two funds?
Yeah, so it's been changing a lot because of the exits and the acquisitions that we've been making, but we're right around that $400 to $500 million mark between the two funds.
Yeah. Okay. And so for the purposes of today, I mean, I think you got two great funds, and both of which I think should be in somebody's portfolio, and for various reasons. But I think for the purposes of today, we're going to dive into the Industrial Services Fund and get a little bit more granular with it. So, yeah, I'm excited. Thanks so much for explaining all that.
Yeah, absolutely. So yeah, like you said, Ian, kind of touch on industrial. We'll go a little bit more in depth. Again, feel free to kind of go back and forth if you got questions. Just let me know if you need clarification on anything. I'm happy to do that.
Yeah, and just to confirm, at the end of the call, we're going to go through a Q&A. On the bottom of your screen, if you're listening live to this, there's a Q&A button that you can type in questions throughout the call. And then for the last 20 minutes or so, we're going to have a little bit more of an open discussion around any Q&A questions that might come up.
Perfect. Yeah, so just kind of further to that, when we're looking at how we really started and how we wanted to differentiate ourselves, again, industrial was that first sector that we started a fund around. But for us, it was really important, one, to specialize, and two, differentiate ourselves in the private equity space. So typically, like looking historically, private equity has been, you go out, you raise a bunch of capital, and then you go and find these deals. And maybe 7 to 10 to 12 years down the line, investors can then reap the benefits after all of those exits happen. But what we really wanted to do was kind of change the landscape of private equity and tailor it more to the retail investor. So for us, what that meant was investors really look for that cash flow. And because of the nature of the businesses that we were buying, high free cash flow businesses that are going to be distributing to the fund, we thought, well, let's actually create a distributing private equity firm. So that's really how this whole thing started, is we wanted to give investors private equity returns, but along the way, they're going to be de-risking their investment because we're going to be distributing cash to them every quarter. So that's really fundamentally how we built this business. And again, from a mandate and a thesis perspective, what we really wanted to do was create an insulated portfolio from recessionary environments. For us, it's all about consistency. Compare that to the public markets. We want to be far less volatile, right? We love to see that cash flow. We love to see that steady, consistent increase. And for us, that was super important. So taking a look at industrial, again, we buy very boring businesses. At the end of the day, it's a very simple thesis that we have. It has to be code mandated, regulated. And what that does is it creates this recession resilient type portfolio. So in downturns, we want to protect our investors. And when the markets, public markets or markets in general are doing very well, we want to capture that upside. And again, taking a look at the track record, this is exactly what we've been able to do. If you take a look at COVID, these black swan events, recessionary type environments, we've never missed a distribution. And in years like last year, we've been able to have those outsized returns outside of that 8 to 12 targeted percent that we have for the industrial fund. So taking a look again, predictable cash flow is key. Creating this recession resilient portfolio we want, whether it's an economic boom, a flat period, or a recessionary environment, we want to make sure that cash flow is going to our investors. That is the main thing for us. And how we do that is we have these code mandated regulated businesses. You're going to hear me say that a lot, but I think it's just very, very important. It's a very specialty part of our portfolio that really makes us consistent.
So Kyle, you keep talking about this cash flow. I'm wondering, can you maybe speak to that? Like, I think one of the unique features of Newlook Industrial Services Fund is that cash flow piece. And I think what makes it unique is that typically it pays out a higher yield from a percentage standpoint, and still you own an equity component. Whereas typically other higher paying yields, it's usually more interest bearing and it's less equity oriented. So I'm wondering, can you speak to that, like in terms of what is the targeted yield? I don't know if you have a slide on that you wanted to share.
I don't have a slide on it, but I'm happy to speak to it. Again, when we're looking at businesses, we want to make sure that they are cash flowing businesses. And how we do that is they have a large portion of their revenue coming from service. So for example, we do fire suppression. So we want people being able to go out and service the alarm systems, servicing the fire extinguishers, servicing the sprinkler systems. That is what creates this recurring revenue for us. Again, looking at our commercial plumbing platform or any of the other platforms that we have, this is that key component, because if the individual companies themselves are distributing cash to the fund, that means that we're able to distribute that cash out to our investors. So for us, the target is 8% as return of capital on a yearly basis, and we pay it out quarterly. So it's 2% every quarter that we're giving to our investors from the distributions given to us by our portfolio companies. So this is what really helps on a yearly basis create yield for our investors and really help de-risk the investment for the investors as they're continually getting cash back.
So let me be clear. Somebody is getting buying into an equity share of the portfolio of all of these companies, and they're now participating on that cash flow basis of a targeted 8%. So again, the fund manager in theory could de-risk that based on the performance of the portfolio, but their targeted yield is 8%. And if there's additional cash flow, they could certainly push off bonus distributions. Certainly, that's been your mode of operation. But certainly, speaking of the target, it's 8. And you also have this unit value that, in theory, is able to move upwards, but also could move downwards as well. Is that a fair assumption?
Yeah, absolutely. And to break it down even further for you, Ian, again, so it makes sense to the investors is last year's a great example. So last year we had a phenomenal exit with IFSS back in July. So we sent out our regular 2% quarterly distributions every single quarter. So we had 8% in quarterly distributions last year. Because of this asset sale, we sent a special 2% distribution to our investors. We retained the remaining portion of that cash and looking to deploy that to further grow the net asset value of our fund. And last year we saw about an 8% growth from $10 to $10.80 in net asset value. So we had about an 18% total return last year, and that's how it was broken out. We had our targeted distribution, our special distribution, and net asset value appreciation as well. So those are kind of the three components that you're going to see as part of the industrial fund.
So in 2024, you did an 18% return. So, and that's a guarantee that you're going to do that every year, right?
Unfortunately, I can't say we're guaranteed to do that. Again, what we're trying to do is just keep the momentum going of these exits. That was our first exit. We've done it 2 more times since then, and we have 4 or 5 more assets still in the fund that we're going to be able to do and replicate this over and over again. So again, I can't promise a certain number I know you're kidding. I can't promise a return.
Just for the regulator's sake, past performance is no guaranteed for future performance. But again, what I would say is your targeted return is 8 to 12.
Yes,
fair?
That is correct.
And certainly, if you own this fund since inception, we're hanging around north of 11%. Fair?
Yep, that's exactly correct.
Okay, and the thing I like about it is, as an investor who's looking to grow, who's dripping units back in, it works great. But those that want this for income, it's really a phenomenal income machine. And here's why. It's not about just the money that you make on an investment, it's the money that you keep.
Yes.
Why I mean that is, so somebody owned these shares directly, not in a registered account. Now you're concerned about the income and the way it's taxed and the money that you're generating off of these assets. The lion's share of it is a return of capital. The problem you ran into last year is not all of it was return of capital. The problem is your performance was so exceptional that you couldn't do it all return of capital. Oh, shucks. Sucks to be you. But, I guess you can sacrifice with an 18% return. In general, though, your quarterly 2% distribution is 100% return of capital. Fair?
Yes, that's correct.
Okay. Thank you very much, Kyle. Sorry for the diatribe there, but I think it's important.
Yeah, absolutely.
Wondering if we can jump ahead, Kyle, just for the sake of time, and talk about the actual underlying assets. Do you mind?
Yeah, absolutely. So I'll give a quick kind of overview of, what we're looking for and how we really create value in these businesses, and then we'll look at the portfolio as a whole. So for us, it's very simple. What we do is we go out, we buy these co-mandated businesses in a certain sector, certain geographic location. We're buying majority stake. So we want to be the ones making the decisions. We go and find great owner operators and we partner with them. So we want to make sure that they're retaining, call it 30 to 40% equity ownership. And what that allows them to do is stay aligned with ourselves, our investors, our advisors. They're going to wake up every single day, partnered with us, wanting to grow the business. So that's the big thing, is they've done a great job in building the business to this point, but they really don't know how to take it to the next level. So we're buying these companies between 4 to 6 times EBITDA. So let's say we're buying $1 million EBITDA company. We're going to buy it between $4 to $6 million. Now we're going to try and organically grow that company to about 2 million. And from there, we're going to add smaller tuck-in acquisitions, same sector, same geographic location, streamline management, create efficiencies, and build out that EBITDA via acquisition until we hit about thresholds of 5 million, 7.5, and $10 million. The reason for that is because at those points, some of the larger players in the space now take a look and they want to come and purchase that asset. Not only purchase it, but they're going to purchase it at a premium. Where we're buying at 4 to 6 times, if we hit 5 million, 7.5, and 10, now you're starting to look to 9, 10, 11, 12 times EBITDA. So this is where that value is really created for us and that exit strategy is created for us.
It's interesting. Elroy, who's the founder and CEO of Newlook, who's your boss, Kyle, he said something to me. He said, for owners who are selling the first chunk, so they're still invested because they still own, say, 40% of the shares. On the second exit, they've talked about how their second exit is dramatically larger than their first exit. Fair?
Yeah, exactly. And that's the conversation that we have with them upon looking at buying them. We kind of explain to them how we're going to create value and how that second exit for them is actually going to be worth a lot more than if they had just kept the company by themselves and ended up selling it down the line.
Yeah, it's a pretty cool structure. And I think one of the major differences of your structure, comparatively speaking to even your earlier iterations and even other asset managers, is around the fact that you're looking for businesses that you can partner with the current ownership structure versus taking them out completely. It's a really, really interesting structure.
Yeah, exactly. And that's, for us, it's all about the people, right? You want to partner with the right people. Ian, you're in the same business, right? It's all about the people for what we're doing and for what you're doing. And we want to make sure that our partners have the same intentions that we do. And that's what's really allowed us to be successful in the last, call it 12 months, the 3 exits that we've had. So again, we're really at this inflection point, which is why we're really excited. We've kind of created this great track record of 3 phenomenal exits in the last 12 months. And we still have this entire portfolio that I'm going to show you here of assets remaining in the fund that we're going to be able to replicate these types of exits going forward. So this is what we're really excited about.
Awesome. So tell us a little bit about the different, I think you guys play in a couple of different spaces. I'm wondering if you can maybe comment on some of those assets.
Yeah, of course. So, again, we're excited about all the sectors that we're in, but maybe just to highlight a couple for you because we're looking at certain acquisitions in these spaces. So what we've done is the Canadian fire suppression space is extremely fragmented. And at the beginning, a lot of these larger private equities, strategics had said, look, we don't want to go and amalgamate all of these companies. That's a lot of work. They're a lot smaller than what we're kind of used to. But if someone's able to do a roll up in the Canadian space, then we're going to be able to come in and actually purchase this conglomerate at a premium. So what we've been working on the last few years here is taking our 8 or 9 platforms or 8 or 9 portfolio companies in the fire suppression space in Canada and creating this overarching national fire platform called Fire Plus. So we brought on a full team. So we've got a president, CFO, full management team for our Fire Plus platform. And they've just done a great job of taking these smaller fire suppression companies, integrating them into one larger platform. So that's something we're really excited about. We have 3 fire suppression companies we are currently looking at, 1 LOI signed, 1 coming up in the next month or so, and a 3rd that we are actively engaged with. So this is a space that we're really, again, trying to hit those certain EBITDA thresholds to make this a saleable asset, probably in the near term. That's one sector. Again, this is highly service-based businesses where you're inspecting, the sprinkler systems, the alarm systems. Every single building, commercial or otherwise, they need these fire systems in there. And that's where that code mandated regulation piece comes in. And that's why it's so attractive to us. If there's 5% occupancy in a building or there's 95% occupancy, it still needs to be tested and checked on a regular basis. So for us, this is what really sets it apart. As long as there's one person in that building, we're going to get that call to do that work.
Awesome. The wastewater management, I think, is one of the most unique features. Tell me about that.
Yeah, absolutely. So this is one that we're really excited about. Again, all about partnering with the optimal operating partners. And these guys have just been phenomenal to work with. So the living water, back in December, there were 2 parts to this investment. There was inside engineering, and then there was the living water component. So we actually carved out inside engineering, which was a lot of the project-based stuff. And we sold that because the market was really hot at that time. We were able to get a phenomenal multiple on that. And again, these owner operators were able to, get a very large portion of their investment back. And what I love about this story is the fact that these owner operators, they didn't take that check and, go buy a house in the Bahamas or what it was. They actually took that money and they doubled down on the living water side. So this water utility in Alabama is very exciting for us. And we have even more alignment from our partners down there because they are so invested. So we do the full treatment of wastewater and freshwater in the state of Alabama. We've done for the last, call it 10 to 20 years, all of the servicing of these municipalities. And we're looking at identifying a lot of these systems down there and actually taking over these systems and working on them because we've serviced them for so long, we know them like the back of our hand. But we're actually going to take over those, purchase them, and again, build out that living water services platform down in Alabama. So that's, effectively operating like a utility in the state of Alabama, which is very, very exciting for us.
Amazing. Any other things that you want to highlight for us in the portfolio? How many? I know that there's been a number of acquisitions and then tuck-ins, but for all intents and purposes, how many companies are you managing currently in the infrastructure fund?
Yeah, so we were up to about 18. And then as you saw, we obviously had sold a few. So right now we've got 4 platforms and we have 14 individual companies that we're currently working on in the portfolio, as you can see there. But we're also actively, again, like I said, 3 different companies in the fire suppression space. We've identified, 10 to 40 different investment opportunities for the Alabama wastewater platform. And we're actively looking at replacing some of the exits that we've had with brand new platforms. So we are looking at and are actually in conversations with HVAC Group, as well as air quality control testing. So these are a couple kind of new spaces that we'd be in. Again, falls right under that code mandated aspect, that regulation piece that we're really excited to hopefully be adding to the portfolio next year.
Fantastic, Kyle. Thank you.
So just moving on here again, I've talked about a lot of these pieces, but Newlook really does try and differentiate itself in a number of different ways. And I've highlighted a lot of those ways already. But from a risk mitigation perspective, again, having that code mandated regulated piece to it really mitigates that risk depending on what part of the economic cycle we're in. A lot of smart money has actually begun to invest in us. So we've got pension funds, institutional investors, family offices. And what this means for us is large groups doing extensive due diligence, ultimately deciding to invest alongside of us. And I think it's just one of those, check boxes for advisors and investors to know that these types of groups recognize Newlook and have decided to invest with us. Another big thing for us is it's a pre-existing pool of assets, and you've alluded to this, Ian, but it's an evergreen structure. So that means we're going to be buying and selling assets in perpetuity going forward. This is effectively the last industrial fund that we have. And what that allows us to do is not be at the mercy of the market if we have another event, a black swan event like COVID. We don't have to sell assets just because the fund has come to an end. We're able to extract as much value as we feel we're able to for our investors. So it really puts us in a great position to be able to buy and sell when we see fit. When the market is hot in certain sectors, when it cools off in certain sectors, maybe that's when we start to buy. But it really gives us that flexibility, which is obviously very exciting for us. Another key piece that I think, again, is very, very important and distinct to Newlook, as a private equity firm, we do not use any leverage. We have no bank debt. We have no fund leverage whatsoever. The equity that we raise here at Newlook is what we use to go out and deploy and buy these assets. And what that means is, as you see all these interest rate fluctuations, Newlook is not affected by these interest rates. Again, from a deal flow perspective, absolutely in the markets, you'll see, periods of hot markets, periods of down markets, but we have no debt obligations because, again, we want to be able to pay those distributions to our investors. So that's a big differentiating factor here for us. From a diversification piece, again, this is very important. We have geographic diversification, industry diversification, right? We're in 5-6 different sectors. We are all across Canada, all across the US. Our US companies bring US dollars to the fund. Our Canadian companies bring Canadian dollars to the fund. So we have, currency diversification in that sense. And we don't buy any of the actual real estate associated with these businesses. So there's lots of real estate in the private markets, and we really wanted to differentiate ourselves outside of that space. So we're uncorrelated to public markets, but we're also relatively uncorrelated to the real estate side of the private markets, which again, I think really makes us unique in that sense.
Awesome. Thanks, Kyle. I think one of the things that I think is also, and I'm not sure if you've got a slide on this, Kyle, but in terms of the management fee structure or the performance structure, do you have a slide on that or no?
I don't have a slide, but I'm happy to talk to it.
I think just for those that are listening, it's very, very common to do a high, like most funds have a high water mark, where the fund has to hit a high watermark, and then there's a performance fee or performance bonus on it on a split basis. And so what's very common is, say, a 7 or 8% high watermark, and then it's like an 80-20 split. That's right. Probably the most common structure you see in private equity. And I would say Newlook has kind of re-envisioned that structure and created a totally different structure. And Kyle, I'm wondering if you can kind of speak to that.
Yeah, absolutely. So for this evergreen structure, what we did is a 95-5 GP/LP carry. So what that means is effectively Newlook is aligned with its advisors and investors because we have 5% ownership of the fund. So again, it's not your typical 80-20 split after we have exits, because again, we're going to be exiting and acquiring kind of throughout the life of the fund. But what this means is we are incentivized to distribute to our investors because we get 5% of those distributions to align ourselves with our investors. Same with net asset value. We have no reason to suppress the NAV. We want to make sure that we're growing the NAV and doing it fundamentally in a consistent fashion, because what that allows us to do is we own 5% of the fund. So from a high watermark perspective, Ian, if the NAV drops below the point of where it is, that it has to get back above where it previously was for us to make more than what we had before. So there's kind of an effective high watermark. But again, it's like Newlook always has that 5% ownership of the fund. And that is aside from the NAV that you see as an investor and as an advisor. So that's already taken off that.
Yeah, so let me to kind of put it in layman's terms here. Essentially, what you guys have is a little bit of a different structure. That there's no really high watermark other than to say that you have a permanent high water mark of wherever the NAV is. So as you create distributions, all clients are getting the distributions, but on the back end, there's a 5% carry that's going. So essentially Newlook is receiving 5% of those distributions. So if there's $100 that goes out, $5 is going to management, $95 is going to all the investors. And then as the NAV increases on the share value, it's going up. And as it goes up in value, 5% is being distributed in terms of that additional value to management, and 95 again is going to clients. However, the only exception to that is in the event that there are difficulties in the fund and the NAV drops for various reasons. And so let's say the NAV dropped from $11 down to $10, theoretically, it's got to climb back to $11 before there's ever a GP split of that 5%. Does that make sense? Am I on target there, Kyle?
Yeah, I would say so. Again, like if NAV ever were to, decrease significantly, our ownership percent stays the same, but our ownership value decreases with the investors. So again, we're aligned with you guys, and we are just at a detriment if that ever were to happen, just like the investors.
Yeah, but I guess where I'm going is it's not like you're getting a 5% in additional
No.
lift there. So again,
Correct.
I think it's certainly a relatively accretive structure that certainly creates increased alignment with us as investors. So thank you very much, Kyle, for that. Anything else before we go to Q&A that you wanted to highlight for us?
Kind of just speaking with the industrial team the other day, just talking about what we're seeing in the markets. They're very optimistic from an acquisition perspective. So again, we've had 3 phenomenal exits, and we are looking at replacing those with some acquisitions coming in 2026. So the pipeline looks phenomenal. Whether that be fire suppression and the wastewater, but also brand new platforms that we're looking to add on. The market in general down in the US is extremely hot. So from an M&A perspective, the industrial market there's a ton of activity going on. So that's very positive for us. And again, staying from a stability perspective, we really don't see those multiples change a whole lot from that 4 to 6 times. So that means the thesis is going to continue to be able to be proven out. Because again, from us, we play in this market where these larger groups just don't have the time to do that. We create these companies that then these groups can come in and purchase. So they purchase at a premium because we're able to take fragmented markets, combine them. And again, not using leverage, these other groups can come in and they pay a premium because we have no leverage on them, and they can employ leverage at that point.
Thank you very much, Kyle. Really
Absolutely.
Helpful. I'm wondering if you want to take down your deck, and we can just kind of have a more clear conversation without the deck on, and we'll dive into a few Q&As here. But one of the things that I just thought I'd highlight that I think stands out for me with Newlook Industrial Services Fund 3, and I know you've kind of dropping the 3 because it's kind of the last alliteration of, or a last version, I should say, of your industrial services. It's been such a smooth curve. Do you know what I mean by that? Like if you have a curve of like, okay, you start here and you look at the income, like in terms of, income yield and growth yield, you're really boring, Kyle.
Yeah, I know. And honestly, it's what so many people say too. It's like, what you guys do, and it's our tagline, right? We do boring businesses. And, in these types of environments, I'm okay with being boring. And, the team here is okay with being boring. We really do love boring because consistency at the end of the day is what builds wealth. Volatility is what scares a lot of investors. And we're really trying to take that piece out of the investment equation for people.
Yeah. I've got a couple questions in the queue that we'll dive into momentarily. Just as a reminder to those that are listening, we're going to go into some live Q&A. There is a tab at the bottom of your screen. You feel free to type in anything you like, and we're going to go through that. The first question, and I think it kind of sort of speaks to this is kind of what is the minimum investment and typical investor profile. And I mean, there's almost two questions in there. So first of all, what's the minimum that one can invest? And then what's the, typically where are you seeing clients using this in their portfolio, or what kind of clients are investing in Newlook?
Yeah, so our minimum investment across the board is $10,000. So again, we really wanted to structure a product that's available to all retail investors. Again, we see ticket sizes anywhere from $10,000 up to, $5-10 million. So it is a very wide range of our investor profile. To answer the second question, Ian, I don't know if you wanted to maybe speak more to the investor profile that you see, but from my side, it honestly is anywhere from young couples looking for a little bit of income to older clients who again have payments or maybe are on a fixed income and they want that cash generation with some equity upside as well. But we see it all across the board from an investor profile perspective.
I think the answer to that question is awesome clients. Like if you're an awesome client, you're in Newlook.
That's true. I like that answer. That's perfect.
Okay. You can steal that answer, by the way. Okay, so dropping into, can you explain more about the redemption process? And I'm gonna kind of, that was the question, but I want to kind of bleed into this a little bit, specifically on one asset manager that we have exposure to as our clients, but I know that there's other private equity funds out there in the ecosystem, specifically in the real estate side, that are having a bit of a liquidity crunch. So it could be that the fund is doing fine, but there's a liquidity crunch because for whatever reason, there's a bit of a run at the bank, meaning that there's more people wanting to redeem than there is available cash flow. So I'm just wondering if you can speak to your redemption process, first of all, and then second of all, if you did have a higher than normal redemption run, what would that look like for Newlook? I'm wondering if you could speak to the capital stack on that end.
Yeah, for sure. So from a redemption process perspective, again, we have quarterly liquidity, and it's as a function of the units of the fund. So as the AUM of the fund grows, the liquidity is actually going to grow as well. But effectively, the investor would just submit a redemption request to Newlook, and then the following quarter, again, we put you in the queue, and then you're able to be paid out that following quarter. So it's a relatively simple process. I think it's pretty standard across the industry. And then kind of to your second question,
and I'll just kind of tie that with, there is a 5-year hold on the units, meaning that you can generate the cash flow immediately, but recognizing this is meant to be a long-term hold. If someone needed for emergency reasons to get out early, they could. But again, it's meant to be at least a 5-year hold. Fair?
Yeah, no, I think that's a really important piece, Ian. Again, we want to make sure that is pretty clear. Again, at the end of the day, we're buying real businesses. So we want to make sure that we're able to support those businesses, grow those businesses, and create value for all of our investors. Again, we do keep reserve cash on hand to make sure we're able to service those redemptions. And then a nice piece again is the fact that we're buying these businesses that are cash flowing on a regular basis, that are always sending distributions up to the fund, is we're always getting that cash again to be able to service those distributions or those redemption requests.
So the second one on that, I think you sort of answered it, but wondering, based on the size of the portfolio, you talked about growing liquidity with the fund. Mm-hmm. Do you guys keep a reserve fund or a line of credit to service redemptions, or what does that look like in the capital stack?
Yeah, for sure. So again, we always keep an extra, portion of cash on hand in case redemptions do exceed, what we have outlined in the OM on a quarterly basis. And we do have access to lines of credit as well, through, certain partners with our management team. So we have multiple facilities that we're able to kind of go above and beyond those redemptions if need be.
Yeah, and I know the answer to this, but I was just poking and prodding at it. You guys do carry a minimal, but some debt at the company level. But on the fund level, there is no debt, right? So to say that you guys have a big credit facility at the fund level and then say there's no debt, it's kind of like, I don't know. It's a yin and a yang, right? So
Yeah. So we don't use the credit line at all. Again, in kind of worst case type scenarios, we have it available if need be. So we've never had to use it, and we haven't used it to date. So
yeah, and it's specifically in place to service higher redemption periods than
correct.
Expected. So.
Okay.
Okay, thanks, Kyle. I've got another question. The question reads as this. Hi, Kyle. Thanks for the info. Does the distribution grow with the asset appreciation? So a steady 8% distribution. What I think my understanding of that question is, if the NAV grows by 10%, could one anticipate an 8% lift, or sorry, a 10% lift of the 8? Does that make sense?
Yeah, so it is correct. The 8% grows with NAV. So if you had invested at our original $10 NAV price, you're getting 8% at that point. And now that it's grown to $10.80, you're getting 8% of $10.80. So from your original subscription, that 8% has actually increased a little.
Amazing. Amazing. So what you're telling me is that as the NAV grows, it's not going to shrink from a percentage standpoint, the distribution.
Correct. It's 8% of NAV.
Wow. So cool. Well, I mean, and I think from a long-term perspective, it certainly speaks to the value. All right. I'm wondering, I've got a couple of different questions here, and I'm trying to summarize them in my mind in terms of what would be the most fruitful or most valuable. Here's a great question. I think this is, on point, is how frequently do you report results to investors, and in what format? So from a reporting standpoint, what does that look like? And again, obviously, if somebody's working with us here at Ardill Group, we certainly try to keep clients informed of what's going on. But I think that there's also an onus of over at Newlook, because ultimately, legally speaking, a client becomes a client of Ardill Group and Newlook. So what does it look like in terms of their interaction with you?
For sure. So on a yearly basis, we have a full audit from one of the big four. So that's when we updated our NAV at year end. And then we use that framework to update the net asset value on a quarterly basis. So from a reporting perspective, we are updating our Newlook portal. So if you, as an investor, go into your Newlook portal, every quarter we are showing the change in the net asset value. Now, what I'm trying to do is increase the frequency of communication to our investors. So what I'm going to be, kind of doing on a go forward basis is quarterly updates sending out. We had done a few last year, but I want to make that more frequent to the investor, so they stay on top of what's happening at Newlook.
Awesome. Thanks, Kyle. Yeah, I mean, I think one of the things that's interesting is, as an investor, you can you get your email into the email chain, so to speak, of, sometimes Newlook will put out a special newsletter or news bulletin, and and what I hear you saying to me is that you're trying to make that more regular or systematic in terms of giving a quarterly update. And then there's an online portal that's available always. And so great information. I'm going to kind of wrap up the questions this way, and I'm wondering if we can maybe kind of just wrap it up with a bow. When it comes to Newlook, why should we be invested with you? Like, what's why, if I'm a client or a future client of Newlook, why should I get excited about trusting you with our capital or with my capital? Why should I trust you?
Yeah, no, absolutely. And I think, a big part of that is, like I'd spoken about, the track record that we've created. This used to just be a thesis. This was just the mandate. And then again, last year we were able to take a company that we had bought for 4 to 6 times EBITDA. We grew it, ended up selling it after about 5 years, sold it for about 11 times. So that happened once. And then in December of 2024, we did it again. And then in March of this year, we did it a third time. So now we have replicated the result 3 times, and we have a lot of assets left within this fund to be able to do this over and over and over again. So I think the track record speaks for itself, for one. Two, I think the diversification that we offer as Newlook and how specialized and how honed in we are. We have a full team on industrial, a full team on dental that really focus on these very specialized funds. And I think in this day and age, you have to be a specialist, not a generalist. So I think that really sets us apart. And third thing is, we do everything fundamentally. We are not financial engineers. We look at these businesses in depth, and we make sure the reporting that we are doing is fundamentally driven. And I think that's really why investors and advisors can trust us. And again, the track record speaks for that fundamental value.
Kyle, thank you for doing a great job of stewarding our clients' capital. Thank you for doing a great job of stewarding my capital, and so appreciate Newlook and the incredible team that you represent here today. Couple notes from us here at Ardill Group. If you were on the call live with us today, we're going to be sending you a special email tomorrow or later today with a special thank you with a Tim's card just saying thanks for joining us, and I hope you can enjoy a cup of coffee on us. Thank you to our sponsor, Newlook Capital, for sponsoring those Tim cards. So thank you very much, Kyle and team. And this is the last of 6 coffees with Ardill this year. I'm shocked at how many of you have decided to join us. It's been great kind of having these interactions. I hope you felt valued and appreciated, because I certainly value and appreciate the time that you've given us. We are going to be diving in on a fresh round of series in the new year, probably starting in February with a new coffee with Ardills. So look forward to joining us next time. Until then, if we don't speak to you, wishing everyone on this call and listening to this recording a very Merry Christmas and Happy Holidays. And so grateful to be with all of you here today. Kyle, thanks again for joining us.
Pleasure as always, Ian. Thanks so much.
Okay, have a great one. All the best, guys. Have a great day.
See ya.